Let's get ready to rumble. What's up, guys? It's Mr. Fit to Flourish. Welcome to the Fit to Flourish podcast. Today, we're going to be talking about chart reading basics for the stock market. So there are two basic ways to analyze a stock in order to make a decision on getting into the stock. Now, those two ways are fundamental analysis and technical analysis. So technical analysis is the major focus of a lot of traders, and it involves reading charts and looking at price action in order to see exactly when to get in and when to get out. Now, fundamental analysis involves more in-depth studying or news and also looking at a company's financials in order to make a decision whether or not you're going to be investing or trading a stock. Without further ado, let's get right into it. Oh yeah. So welcome to the reading the charts portion of this trading series and learning how to trade. Let's get right into it. So there's only two ways that the market can go, okay? It can only go up or it can go down. Stocks rip or they dip. So market sentiment is basically the overall mood of the market. How are people feeling about trading? How are people feeling about the stock market and stocks in general? So it's the average trader feeling like buying or selling. Is the average trader feeling like buying or selling? Sentiment can also be described as the market or people being or feeling bearish or bullish. So bearish meaning stocks are going down, bullish meaning stocks are going up or they feel like stocks are going up. Bulls versus bears. Again, this is a big term in the markets. So these terms are used to describe when the market is going up or down. Traders can be called a bull or a bear based on where they think the market is going to go. And then what's the difference? So bulls, they are optimistic. They think that the market's going to be going up, economy is expanding, and in a bull period, the average length of a bull period is about 7 years. Typically, the markets rise 20% after falling. So bears are pessimistic, and they think that the market is going to be going down. It's defined by economy contracting. The average length of a bear market is typically about 1 year, and it's defined by markets falling about 20% from recent highs. So the reason, a lot of people don't know this, but the reason that a bull is called a bull is because bulls attack with their horns going up. And then bears attack by standing up with their claws out and they scratch downward. So that's why a bull is called a bull, because they attack upwards. Bears attack going downward. All right, then we have buying and selling. So buying. So going long is to buy something. So if you say, oh, I'm going long Tesla, then that means you're buying Tesla. If you're going short Tesla, then it's basically you're going to be selling it or buying puts, which you'll learn in terms of options. That's a way to hedge against the market going down. Stocks and options have a bid and an ask price. Again, a bid is the price that a person is willing to pay, while the ask is the price that a person is willing to sell a equity for or derivative. And then you have something called the bid-ask spread, which is basically the difference between the two. So the smaller the spread, the more attractive, the more active the option or stock is. And this makes it easier to make trades if there's not such a large difference in what someone or what people think the worth of a stock is. There are different plot types. So one plot type is called an HLC, a high-low closed bar plot type, depicted here. And then you have line charts that exist, and then Japanese candlestick charts, which you're probably most familiar with. So the most commonly used charting pattern is Japanese candlesticks. So focus on that style only, and then you can check out other styles when you become more advanced. Now, this is the major part about candlesticks. So when you see those charts with the candlesticks, the two things you're going to notice is a green bar and a red bar. So a green bar means that price is going up, and a red bar means price is starting up and going down. So as you can see here, this bullish candlestick, this green candlestick, opens at this price here. This is the open. During a time period, the stock price can move down, and that is depicted by this, what is called a wick, which is this low part. And then at the end of the period, we get a close, which is this high part here. And then during that period, the highest that the stock price went to is this high here. But during that period, we opened here, and at the end of the period, we closed here. So there's different periods that you can measure the movement of a stock. You can measure it in a minute, 2 minutes, 3 minutes, 5 minutes, a day. But basically, when you see these candlesticks, you know that the green means that price started here and ended here. During that period, it could have gone as low as here, could have gone as high as here, but it basically started here, ended here. And the opposite is for a red candle, so a bearish candlestick. It opens here and it ends here during a period of time, okay, a given period of time. And then the highest it's been was up here, the lowest it's been is here. But basically we're saying during this time period, price went down. How do I know that? Because this candlestick is red. It started here at the open and it ended here at the close. Now the middle part of these sticks are called bodies, and then these skinny parts are called wicks. So again, the time periods that you measure these movements in are called time frames. One candlestick is created by trades that occur within a specific period of time. Now this can be measuring all trades taking place for a stock on a 1 minute time frame all the way up to a day or a month. So it's just based on the selection you choose on your trading platform how you want to visualize the action of price on a chart. So you can ask for measurements on a 5 minute period or a 10-minute period, an hour period, etc., etc. The longer you want to hold your trade, the more time you'll need to capture your candlestick. So you'll probably want to look at like the daily time frame or a weekly time frame, something like that. If you're going to be holding for longer periods of time, if you're going to be getting in and out, then you'll probably want to see the smallest movements of the stock. Therefore, you'll be looking at the 1 minute, 3 minute, 5 minute time frames. If you're day trading, it's recommended to trade on the 5 minute time frame, and you'll use larger time frames to confirm your idea about a trade being correct. And you'll learn about that a little bit more later on, because the trend is your friend. If you see something going up, then you kind of want to stick with trading to the upward direction. If something's going down, you kind of want to stick with trading to that downward direction. Smaller time frames can cause you to jump in on false breakouts. Will make sense a little bit later as well. And then once you finish this course and you practice a few trades, so once we get over all these videos, you practice a few trades, you'll likely be advanced enough to trade smaller time frames like the 1 minute time frame, etc., etc. And then to review again, a green bar means that price is going up, a red bar meaning price is going down. During a given time period, we open here and we close here. During that time period, the low was this number here, the high was this number here, but generally with a green bar, we started at this bottom part of this body, of this rectangle, and we ended at this high part, which is the close. And then on a red, meaning we went down, we started at the top and we ended at the close. And then the middle parts are called bodies. These tails are called wicks. Now, this video is to be continued because there is a lot of gas on getting into trading. So I will see you on the next one. Peace. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.